We are now at the beginning of a major economic change. This is not only about the recession that is expected to happen at the end of 2023, in Western major economies like the United States and Europe. This recession is already well known. More problems will emerge as the high interest rates start to slowly hit the business sector. In this video, we will look at 3 insights from the legendary investors, Ray Dalio and Howard Marks. They both have their views of this change, but they both seem to agree that things will be very different. Then we will dive into the specific as to why this change is coming. This will be from the Bridgewater team, which is the world's biggest hedge fund founded by Ray Dalio. So let's get into it.
What I mean by paradigm shift is there are environments that have certain characteristics and they end. And then you have environments that have other characteristics and they end, right? So the 30s was one way, the 40s was another, the 50s, non-inflationary growth, the 60s, the breakdown of the monetary system, the 70s, the acceleration of inflation, the 80s, the disinflationary growth, the 90s leading up to the bubble. Every decade has, not necessarily a decade, but these periods. And then what happens in those periods is that people get so used to those periods that the ironic thing is that kind of late in those periods, the markets are discounting those periods to continue, even though at the beginning of them they don't. So the markets sort of go from not expecting it to then at the end of the period sort of discounting it, and then you have the big adjustment in the markets to whatever that new paradigm is.
What are we shifting from and what are we shifting to, and why do you think the shift is occurring?
Shifts occur because the forces behind them cannot be continued, right? And yet they're extrapolated, right? So I think when we think about this particular paradigm shift, I think about 2008 and 9, creating an environment in which there was a great easing of monetary policy with the lowering of interest rates. And then it was an ideal environment for capitalism because we had then corporate tax cuts. We had big margin expansions. As a result of the big margin expansions, it was very good for those who owned stocks and less good for those who were the workers. We had then a big increase in the wealth gap. Consistent with the monetary policy, we had quantitative easing that had the effect of buying a lot of financial assets. And those buying of financial assets drove the financial assets up, drove future returns down. It created a situation in which we have a wash with capital, right? All the investors have just so much money and they're chasing those investments, which is driving future returns down. Each one of those things can't be extrapolated, right? We're not going to have the same magnitude of interest rate cuts. We're not going to have another round of corporate tax cuts. We're not going to likely have the same kind of margin expansion. And so we're now at a point where we can pretty much be sure that those things are not going to be extrapolated, okay? And so then we're approaching a paradigm shift.
53 years in your investing career, there have been 3 sea changes, and we are in one of them. What does that mean?
Well, a sea change is a major transformation of the environment, a complete change in attitudes, etc. And I suspect that we may be at the beginning of one. The first one was the fall of interest rates from 20 to 0 between 1980 and 2020, which had very, very positive effects. The second was the opening of investors' minds to what we call risk-return analysis. And before the 70s, the job of the investor was to avoid risk. After the 70s, it was to intelligently take risk, and that was a big change. And I think that we may be on the doorstep of the third.
So what is this sea change?
Well, since
since
the Fed, central banks around the world, and the Treasury took strong action to solve the global financial crisis in 08, 09, we have been living in a highly stimulated, very positive, easy money environment for roughly 14 years. And I think that, a lot of people began to invest or came into the business in those 14 years. Not too many have a perspective on the period before the global financial crisis. And they may think that the last 14 years was normalcy. I don't think so. I think it was the best imaginable period for borrowers and for asset owners. And I don't think that it's necessarily going to continue.
So that stimulative rates are a thing of the past, and now we should just get used to higher rates for longer, even though the market is sort of thinking that they might go down next year?
Well, I don't think that we should expect, I don't think it's prudent to expect to have stimulative rates all the time. I describe that as taking a shot of adrenaline every morning. I don't think it's very viable. We'll see lower rates. Well, first of all, when the battle against inflation is won, I think rates will, the Fed will bring the Fed funds rate back down. And we'll see very low rates again if there's a recession that has to be cured over time. But I just think that, people got so used to zero rates of interest. Right. The Fed brought the Fed funds rate to zero late 2008 to fight the global financial crisis and left it there for 7 years and had a dickens of a time raising it because it thought it thought that we shouldn't permanently be at zero, but the markets had tantrums and resisted. I don't think that, what I say in the memo, I don't make many predictions. I don't believe in predictions, including my own. We don't bet on predictions at Oaktree. But what I said in the memo is I think that for the next several years, the Fed funds rate is more likely to average between 2 and 4 than between 0 and 2. That's as far as I can go.
The second part, as we talked about in the credit pipes, is thinking through. It's been interesting to watch the bond rally. So there's been a huge bond rally since this happened and a volatile one. And is that right? Do the mechanics make sense? On one hand, there's the obvious knee-jerk reaction, banking system in trouble, Fed eases, all rates come down, right? That's the market pricing, and obviously makes a lot of sense. But this is first order going to be very difficult from a duration perspective, because if you take the last 3 years, the central bank and the banks were the entities buying all the bonds. There weren't other players buying bonds, maybe in the swap market here or there, and so it's not a total black and white, but by and large, that's the duration issuance. Now, as a result of the higher rates and the tightening, there is less private sector issuance, so that helps a little bit in terms of the mismatch. But the government's actually budget deficit's rising again, and I'm going to have to do a significant amount of issuance in the coming year. And it's not going to be banks, and unless economic conditions turn a lot, it's not going to be the central bank. So where's that duration going to come from? That's a big question, and we think that actually leads to higher interest rates, and a steeper yield curve are probably going to be a necessary outcome of this.
And then when it comes to the duration issue that Greg mentioned, just size for us how big a deal it would be if banks significantly pulled back on their duration purchases. What would that mean for the whole, for example, in the Treasury market?
Yeah, if you look at where the budget deficit's likely to go, we're probably going to see 5 or 6% of GDP once we get a year or two out from here. And, just pencil in the assumption that in the near term, banks are not in the market or are selling a bit. And the Federal Reserve is, of course, also selling a couple percent of GDP, 2, 3, 4% of GDP. So you get to a number that's like 8, 9, 10% of GDP that has to be purchased in duration. And that doesn't happen. That it's been very few times that has happened in the last 100 years. There are maybe a couple of times when foreign central banks were buying a lot of U.S. bonds in 2005 and 6 when they were accumulating reserves. That can make that market clear. When the yield curve is steep and a lot of players have the incentive to go fund at zero and buy a steep yield curve, that can make it work. But if you just look at the organic savings generated by the economy and how much life insurers and pensions are going to buy, you get to something like half that number. And obviously the bond market will clear, but the question is at what price and to the expense of what other activity? Are you going to need a much steeper yield curve, higher bond yields? Are you going to need other asset prices falling as people sell them to move into the bond market?
Finally, let's look at the takeaways. Easy and super low interest rates will not continue. Even if there is a recession, the Fed could lower the interest rate, but face a dilemma on how the federal government can finance its spending. The choices are either a. Keep the interest rate higher than previous recessions but face an economy that does not bounce back quickly. B. The Fed can lower the interest rates. At the same time, it needs to buy government bonds to solve the government finances. Effectively, the latter choice will be a QE. This could lead to a major devaluation of the dollar at the end. This could lead to a change in the New World Order. Thanks you for watching. Please support our channel for more contents like this.